Good afternoon. I think we are live, so welcome everybody to this very special webinar. I'm Kit Winder, I'm the Senior Analyst here at ByteTree, and this week on Tuesday morning at 8 a.m., the 21Shares Bitcoin Gold ETP Bold launched on the London Stock Exchange. It's the first of its kind to list on the LSE, three and a half years young in Europe and about 48 hours old in the UK, and so it's perfect really that today we have both sides of the collaboration, ByteTree and 21Shares, here to explain the underpinnings of this unique product. Today, you're going to learn about the Bold ETP, how it works, the assets, the storage, the transactions, everything. If Bold is the cake, we're going to look at the ingredients and the process that make it such a unique product. You're going to walk away with a very clear picture, I think, of exactly how Bold works and exactly what it is. So to do this, we're joined by our founder here at ByteTree and the creator of the Bold Index. That's Charlie Morris. Welcome, Charlie.
Thank you, Kit. Nice to be here again.
And then we have Adrian Fritz. Adrian is the Chief Investment Strategist at 21Shares, and he's responsible for shaping their global market outlook and communicating their investment theses on the digital asset universe. Before entering the crypto industry, he worked in traditional finance for several years, management consulting, corporate finance, and investment banking. And that brings us to today with gold breaking record highs, geopolitics, the money supply growing, and even a little Bitcoin breakout today and this week to celebrate Bold's launch. It really is the perfect time to be talking about this product. But before we go any further, we have to say this is not investment advice. Do not take anything as a recommendation. But it is a live and interactive webinar, so do send in your questions. Charlie and Adrian are very much looking forward to tackling those in the second half of this conversation. So send those in using the Q&A box, and we'll get to those later. But I think, Charlie, you're going to lead us away with a chat on Bold.
Fabulous. Thanks, Kit. And Adrian, have you said hello yet?
Well, thanks for having me. I think it's a very exciting time to be here. Obviously, we're also very excited that Bold finally hit the UK market. And I can't wait for the session talking about the two most exciting assets in the market.
Okay, good stuff, Adrian. Now I'm going to pitch you the Bold Index. Now I know you know it backwards, but just pretend you're learning as we go. And what you can do is you can stop me at any point and ask a question. You don't have to, but then we'll come to you after this. Yeah, it's really for people who haven't seen this before, just to explain what it is we're talking about. So I'll kick off with a quote from Ray Dalio, one of the great portfolio construction guys. He's a successful hedge fund manager. And he made a quote a few years ago: I would take the gold, I would like to sprinkle a little bit of Bitcoin into that mix too. And here at Bold, that's exactly what we've done. So at ByteTree, we're a research company and we build diversified portfolios around the money map. Above the line is inflationary environment, below the line is a disinflationary environment. On the right is risk on, markets are go-go, and on the left, their markets are soft. And it's our understanding that gold has always liked a risk-off environment with inflation, and Bitcoin's always liked a risk-on environment. And when we've had inflation as well, it's been spectacular. So, gold sits up in the top left box alongside inflation-linked bonds, TIPS, and Bitcoin sits next to value assets, which would be financials, banks, and also commodities and heavy industry. Below the line, we've got disinflationary assets, things that work when when everything's going well, bonds and equities. In particular, bonds align themselves with high quality equities, the sort of stocks we find in Switzerland and the consumer staple sector, healthcare, that sort of thing. And then on the right, growth stocks, and we're very familiar with those. So we like to build portfolios around that. And it was, the inspiration for Bold was two very liquid assets, Bitcoin and gold, paired together as a sort of inflation hedge, as it were. Let's get into that. How much Bitcoin and how much gold in your portfolio? Well, there's lots of ways to do that. If you can predict the future, then do so. But if you can't, then how about risk weighting it? So rather than putting 50 in one and 50 in the other, how about putting the same amount of risk in each asset? And we do that by historic volatility. This is the 360-day volatility of Bitcoin and gold. Bitcoin was once upon a time extremely volatile, and that volatility has been coming down steadily over the years as it's grown up and its liquidity has improved and it's become more widespread. Gold's volatility has always been quite low and consistently so, although recently it has been picking up because, let's face it, gold's a pretty interesting place right now. So this is the very simple maths that you need to do to make a bold index. Not that difficult, thankfully. So you plug in, and this is done by Vinter Kaiko, or Kaiko, our index company, who are based in Sweden. And at the end of each month, they plug in the volatility that they observe over the previous year, 33% for Bitcoin, 17% for gold, as at the end of December. And then they do the 1 over, add them together, you get the blue number. Then the next calculation, all pretty simple to follow, I hope. And the magic output is our target weight. And so the portfolio is rebalanced at the beginning of, or the end of December, to 34.8% Bitcoin and 65.2% gold. Then during the month, so I beg your pardon before I get to that, this is the history of that weight of Bitcoin. So if they're 35 in Bitcoin, that means they're 65 in gold. So when going back to 2015, that's changed a little bit. It's a sort of steady change over the years, but each month by month is a small step. And in 2017-18, Bitcoin was very valuable, very volatile, I beg your pardon, and valuable. And so the weight was very low. But as the volatility of Bitcoin came down, that weight has been going up. So now it's a record high weight in Bitcoin in the index, just over a third against 2/3 Bitcoin. And then during each month, we have the real world, and that is that Bitcoin prices do something, and so do gold prices. And on the left-hand side, you can see in early 2024, that was when the US ETFs launched, Bitcoin ETFs launched. So Bitcoin was very, very strong at that time. And when a rebalancing came, we had to sell Bitcoin and buy gold to bring it back down to the target weight. Then Bitcoin was weak in May, and we had to sell gold and buy Bitcoin. And you can see what that process has been happening incrementally every month. Sometimes those rebalancing transactions can be quite large, 4, 5, 6%. Sometimes they can be tiny, 0.2, 0.3%, something like that. But as we'll demonstrate, this is a process that adds value because there's a big secret in investments, a secret strategy that's been known by special people for thousands of years, and it's called buy low, sell high. And that is what we do here at ByteTree. So that's the performance of Bitcoin in black over 8 years. And I will make it very clear, we started this chart of the Bitcoin high in the middle of December 2017. If you started any time before that, then Bitcoin's just through the roof. But I do believe quite strongly that the J-curve phase of Bitcoin ended in the end of 2017, and now it's a mature, stable asset, much more so than in the past. And over that 8-year period, gold's done very well. Bitcoin's done even better, but with more volatility. And gold has beaten both asset classes. And then lagging in the background in red are the world stock market, including all the big tech stocks, total return, including dividends. So that's how the framework has looked. And I'm trying to explain why gold has beaten both Bitcoin and gold. So we now take it, because I think that the misconception with gold is, okay, well done, Charlie, thank you. I'll just go and buy some Bitcoin and gold. That's great. And gold adds value. And that's the key point here. So we've got Bitcoin and gold have done very well. The dotted line that I've added is the average return of those two assets. Gold is not the average return because we're doing two things. One is the asset allocation, which helps to reduce risk and maintain it. And the second thing is rebalancing, helps to add return. And that is very clearly demonstrated by what gold does against the average of the two asset classes over time. Illustrated by this alpha line, the excess return of gold over the average of Bitcoin and gold. The moment is spectacular because the fund is the gold index is 2/3 gold in a soft Bitcoin environment, a hard gold environment. So of course it's done extremely well. In previous times when that line has been weak, we've had Bitcoin surges where it's underperformed the average. But I think the important point is not where the line is today or what's happened when one of the assets has gone crazy. It's that trend, it's that red trend line, which is basically 5 to 7% per year of excess return from the process of rebalancing. Yeah. Similarly, we look at the risk. So, there are some good reasons to own gold over Bitcoin and gold. And the other one is the risk management. By risk weighting the two assets, and crucially, these assets have low correlation, which means you boost diversification when you put them together. And the volatility of gold is not materially higher than gold, and currently it's about the same. So that's pretty interesting. We're getting a higher return that's ahead of Bitcoin, and we're getting a risk that's not much more than gold itself. And then to frame what volatility means, there's Bitcoin, gold, and gold, as we saw on the last chart, against the Mag 7. So, Bitcoin is much less volatile than Nvidia and Tesla, about the same as Meta, and Apple and Alphabet a bit lower, and then Microsoft is the sort of the least volatile tech stock. But gold and gold are well below, and Bitcoin's more or less just slightly above the center. So, I think Bitcoin has overstated how risky it is in this day and age. Drawdowns, everyone knows that Bitcoin goes down a lot and it also goes up a lot. It's a volatile, well, historically it's been a volatile asset, less so these days. But I think what's important is the drawdown of gold is what it is. It was very, very sizable in 1981, 1982, and also in 2013-14. But actually, it tends to be quite a well-behaved, stable asset. And gold, the drawdown of gold, max drawdown, has really been not much more than gold itself. So again, riskier than gold, but not materially so. Fund managers like to look at Sharpe ratios. That is the risk-adjusted return. So I'm taking over that 8-year period, the annualized rate of return of Bitcoin, gold, and gold, 24, 21, and 26. Looking at their volatilities, the volatility of Bitcoin is high there, 65, because that's taking the 8-year period, not just the last year, which is obviously much lower than that. It would be sub 40. But nevertheless, we get to a Sharpe ratio, which is 0.3 for Bitcoin, 1.4 for gold, 1.5 for gold. Now, 1.5 is very high, which is a good thing. And gold, if we looked at gold a year ago, it would have been below 1. It's only because gold's had such a spectacular year in 2025 that its Sharpe ratio has done well. But nevertheless, you've got a very high Sharpe ratio there, which is unusual for a tracking product. So to sort of summarize, Bitcoin and gold, lovely idea. Absolutely, people should own them, particularly in the current climate. We'll come to the assets in more detail in the Q&A and when Adrian comes in. But the three reasons to own gold over Bitcoin and gold is risk management. If you risk weight the assets and keep that level of risk, then you're in a better position than if you let them loose, let them run wild. The second point is the enhanced returns through rebalancing. So we've got a lower risk and a higher return. And the third one is peace of mind. There's something very peaceful about owning gold, whereas if you own Bitcoin and gold, I think your life would be much more stressful. So Adrian, we'll leave it there. The gold index against the world money supply. Nothing fits this, and nothing I can find fits the money supply as well as this. And of course, the money supply has doubled in 10 years, whereas the gold index is 6-7 times. So, it's a sort of natural leverage to the money printing in the world. But anyway, let's park it there. And I want to now go into your side of it. So for people who don't really understand, the 21Shares Bitcoin and Gold ETP tracks the gold index, which is, created by ByteTree. So it's a partnership that we have. Fabulous firm, 21Shares, 10 billion AUM, based in Zurich and New York. I've got to know them very well over the last few years. And they're great to work with. But, we don't do the product here. There's no Bitcoin and gold sitting in my office. I don't sit there at screen trading all day. It all happens automatically. There's an index that sits there with Kaiko, and that data is recorded by them, and that data is sent to 21Shares. They deal. Adrian, tell us how it all works.
No, absolutely. And I think the first thing I want to say is the gold and the Bitcoin is also not with us, which is really important, and we're going to get into it. But I think you already alluded to it. I think you came up with the brilliant idea, the Bold Index, and it's being calculated together with Kaiko. But the ETP is the ETN is actually the wrapper that makes it possible for investors to get exposure. So it's really the bridge at the very end. But I think Charlie has explained why combining Bitcoin and gold does make sense, also from a portfolio perspective and just giving the current environment. And I think it makes sense to spend a few minutes around how it actually works, what's happening behind the scenes, and why the ETP structure really matters here. Because ultimately, it determines the tracking, the liquidity, and also the risk. But I think it's important to understand that Bold isn't just it's not just two assets in a wrapper. It's really a rule-based strategy implemented with a institutional grade infrastructure. So just to get back to that again, I think the most important thing to understand is, as Charlie explained, that Bold doesn't aim to fix for 50-50 exposure to Bitcoin and gold. But it's really, the equal risk contribution between Bitcoin and gold that make up the index. So again, when Bitcoin volatility rises, it automatically, the weight comes down. And when volatility compresses, the weight increases. And all of this obviously happens fully automatically without any discretion or forecasting. So how is the index being built or how it's governed? I think it's important to understand that the risk logic lives with an independent index that we are tracking with our product. So the idea came from Charlie ByteTree, and it's maintained by CAICO, which is a regulated benchmark administrator. And when it comes to the index, Bitcoin is usually where the prices and the weights are coming from. Bitcoin is obviously priced using CAICO's reference rate across a bunch of different vetted exchanges. And the gold part uses the WMR 3 p.m. London gold fix rate, which is basically the same benchmark that is used across the global commodity markets. So once again, there's no discretion. There's no ad hoc changes. And also we as an issuer don't really have an impact or an influence over those signals. How it goes from the index to the ETP is basically, once again, the ETP is the bridge to the index, and each Bold unit of the ETN represents a precise amount of Bitcoin and gold. And that amount is called the coin entitlement. And obviously that changes based on the underlying methodology, but it also changes because of the monthly rebalancing. And once again, here, there's no derivatives here. The ETP really physically holds all of those assets. And I think it's important, especially nowadays, because you don't want to have exposure synthetically. You want to buy the actual asset. So both assets, when you buy Bold, both assets are actually held in a segregated custody account with institutional grade custodians. And that's really important because, once again, it's not ByteTree owning the assets. It's not us that have it in our vaults. They're completely segregated from us as the issuers, and they're safeguarded with institutional grade custodians. So on our side, obviously, the Bitcoin part, we work together with a bunch of different custodians from Coinbase, BitGo, Anchorage, and so on, while the gold side is with JP Morgan. So I believe, and Charlie, I should know that, but maybe you can correct me. I think it's worldwide the only, at least the first ETN that basically has two custodians, a multi-asset custodian approach, which is quite fascinating and important to note. Yeah. Now, tell me.
Yeah, so I think that's right. It is. We were the first ETP in history to have two custodians, because generally you have an equity product, and they would all be with one custodian owning all the equities or the bonds. But Bitcoin and gold are so different. There was no custodian that could manage them both. And I think the important point for gold is there are 3.5 billion banks in the world: UBS, HSBC, JP Morgan, and the other ones, OCBC in China.
Yeah.
And we didn't want to be in China, so it was JP Morgan was the number one choice. And it's exactly the same structure you'd have for a normal gold. Well, people call them gold ETFs, but they're ETNs. It's the same legal structure that we're using for gold as you would have for a gold ETF in Europe. And
100%.
yeah. So Adrian, I want you to tell us. So I want to put £10,000 into the gold ETP. What happens?
That's a very good question. So usually if you are an investor, you place a trade via your brokerage account, via your bank. What happens in the background is with the ETN structure, there's a so-called primary and secondary market. When it comes to gold specifically, and I guess that's a bit the biggest misconception, the liquidity that you see on screen only relates to the secondary market, basically what happens in that specific order book. What actually matters is the liquidity in the primary market, meaning when you hit that order button, we have authorized participants in the background that create and redeem new shares and basically in the back end buy Bitcoin and gold, which are then being sent to our custodians. What that means, though, is that the liquidity that matters is actually the underlying primary market liquidity. And as we both know, for Bitcoin and gold, we have plenty of that. And it's very important because for the liquidity, the tradability for the end investor, it makes a huge difference, and they shouldn't be scared away from the on-screen trading volume that they might be seeing. But yeah, I would say if you invest £10,000 for the end investor, it feels like buying any other ETF, ETN, or security. And everything that happens in the background in regards to liquidity is connected to the primary market.
Yeah, so I think that's the important point here is that I'm just looking at the screen now, bold London, GBP, £38.24 against £30.34. So that's a 10 pence spread, which is 2 basis points.
Exactly.
So
exactly.
Very tight spread, because you're not waiting for a seller when you buy. When I put my 10 grand in, I'm not waiting for a seller. The authorized participant who's not ByteTree, he's not Kaiko, he's not 21Shares, he's not the custodian, it's another party. It could be one of the big investment banks, or it could be one of the specialists in the city. They're contractually obliged to make a two-way market in bold. Yeah, and if I want to sell £10,000, then again I don't need a buyer of bold. I just need to sell my Bitcoin and gold into the market, which is all done highly efficiently by the process.
Absolutely. And as you mentioned, here we're working together with the big traditional market makers and APs. Therefore, investors usually can rest assured that there's enough liquidity, and they either buy or get rid of their bold product.
Yeah. So if you go back into old school terms, if you're a company doing a rights issue, raising money and issuing shares, that's something you'd plan over weeks or months. Issue documents, but we're doing this in real time.
Exactly.
That's what's happening, really. And so when you look at flows, I mean, sometimes at ByteTree I publish flow data from things like gold and silver and that sort of thing, and you get a sense of whether the market's buying or selling gold or silver, and you do that by measuring the amount of money that's coming in and out of a market, and then the number of shares that adjusts accordingly. So it's an incredibly efficient process, and I'm a big believer in the ETF as a very efficient solution to achieve a goal in investment. Otherwise, if you take the ETF away, it's very difficult to do interesting things like gold or even the S&P 500, frankly.
Absolutely, absolutely. Even on the crypto side, there can be a lot of benefits and advantages because obviously you're not only exposed to the order book of one exchange. I mean, those APs are sourcing liquidities from a variety of vetted exchanges. Therefore, you get liquidity across the board, and that is being translated, as you mentioned, in very tight spreads. So, especially for professional or institutional investors, but also retail, that results in very good execution.
So I think we've covered so far. ByteTree created an index. It's calculated by a company. It's nothing to do with me. If I'm bullish Bitcoin and gold, doesn't matter. That doesn't change. It's an algorithm that they calculate once a month, and they're a regulated entity. They send the data to you. You make sure that the fund is rebalanced to the target weight each month, and then every day when money comes in or out of the board ETP, then the dealing's done as necessary. The custody is independent as well. JP Morgan for the gold and copper and others for the Bitcoin. And then for dealing, the secondary market doesn't matter. You're not buying or selling against someone else. You're dealing the primary market. And gold's one of the most liquid assets in the world, $150 billion a day, and Bitcoin's about 40 billion. These are the two most liquid alternative assets on Earth. And that's why the pairing is so good for a deep liquid monetary hedge. So that's the sort of basis of it. We haven't talked about rebalancing. And, so we publish the data for the Bold Index. People can go and rebalance themselves. It's obviously return seeking. It really matters. It maintains your risk. It adds value. If you did it yourself and bought and sold Bitcoin and gold ETPs, then you would have a tax bill, maybe not in Switzerland where Adrian is, but you would do in the UK. And you'd also have trading frictions. Why did 21Shares do that more efficiently than someone could do it themselves?
I mean, first of all, it's because it's all automated. And once again, as you said, I think the rebalancing can be misunderstood. Obviously, the index recalculates on a monthly basis, but that doesn't mean that the ETB just dumps assets into the market. So also the rebalancing is executed through the primary market using professional trading desks, meaning on a monthly basis, we get the calculation of the new weights, and basically APs or market makers, they internalize those flows where it's possible. So the good thing is here that the rebalancing really happens around the market, not through the market, and that ensures that on a monthly basis we have the most efficient way to get that exposure.
And you're dealing at the 3 p.m. fix on rebalancing day. So that's the most liquid time of the day for gold. So it's
exactly
tight spread time to trade. And you guys know what you're doing in Bitcoin. You've been running Bitcoin ETFs since 2018. If 21Shares don't know what they're doing, then no one knows what they're doing. So you've got expertise and a great time window to be doing that. So
I mean, as you said, the Bitcoin fix is at the same time, also 3 p.m. obviously, and you basically take the last 60 seconds of the trading day. You take the prices or the last trades of all vetted exchanges and take the mean price of that. So because once again I said that earlier, because Bitcoin trades 24/7. It's kind of like a synthetic fix, not just with gold. On the other hand, it is the benchmark, while with Bitcoin, it's kind of like a synthetic fix, but we make sure we basically hit both of them at the same time in the most professional way.
Excellent. Kit, do you think we've done enough for now and we should move to Q&A? Or do you have any questions before we go there?
Well, I think over to Q&A is the right response. We've had a number of questions in already. And again, just to reiterate to everyone watching, there is a Q&A button, and this is your chance to ask Charlie or Adrian any of your particular concerns. We've had some in. So firstly, I'll just say thank you both. That was a great run through. You were just talking about rebalancing there. There's obviously a cost to rebalancing. I don't know, Adrian, if you want to speak to how the timing maybe lowers the cost or the cost of the strategy of the rebalancing every month.
Yeah, there's obviously some costs, but because the good thing is that the costs are on our side. Of course, as an investor into the Bold ETN, you pay a management fee. All the costs that occur for the rebalancing, that is on our side. And obviously, we're trying to, I don't know, make sure it's as efficient as possible to keep those costs low.
And Charlie, I mean, you would have something to say. There's a cost to rebalancing every month, but there's also a benefit, and you talked about that in your pitch. So when you square those things together, the cost of rebalancing, you would say, is definitely worthwhile.
Well, the cost of, the way it's done by the ETP is de minimis. I mean, it's, they're trading at the fix, right? The Bitcoin and Gold fix. There's the spread between doing it is nothing. Now, if you try to do it yourself, it'd be much higher, and it'd be taxable in the United Kingdom. So this way, it's not taxable, and it's done by professionals. And 3.5 years of evidence since this product's been around shows they're very good at it. So there you have it. And yeah, the benefit is rebalancing adds 5-7% per year.
So when you square away sort of professionally managed low rebalancing costs against the benefit, I think that answers that question. What I think this has largely been answered, but how do you feel about, well, someone is asking, what do you buy to represent gold or Bitcoin? You've answered that. You have counterparties holding the real thing. And I guess just an evaluation of the counterparty risk that you feel that you face.
Yes. Yeah. I mean, it's real gold, real Bitcoin.
With the higher.
Exactly. And once again, all segregated, and we like to call it bankruptcy remote, especially from our side as an issuer. In the worst case that something happens to us, all the assets are completely segregated, and therefore investors still have a claim on those assets.
Perfect. Thank you. As a UK investor, what are your thoughts regarding a currency hedge? Would you buy the GBP or the USD product?
Can I take that, please, Adrian?
Of course.
Yeah, there's no currency hedging. You're just buying a different a share class and a quote. So they're exactly the same investment. You've got the same amount of Bitcoin, the same amount of gold, and there's no currency hedge. It's just the share price is expressed in pounds or expressed in dollars. And indeed, we've got one in euros in France, and one in Germany and Netherlands, and we've got one in Swedish krona in Stockholm, and we've got one in Swiss francs in Switzerland. So, and they're all the same investment. You would have exactly the same return. It wouldn't matter which one you bought. But the practical answer for a UK retail investor is, your platform. If you're a GBP guy, then your platform to buy the dollar product will charge you an FX, which could be quite costly. Some platforms really rip you off on that. And so I'd buy the GBP if you're here. But if you're a US dollar investor, I'd buy the US dollar one. It's the same investment, but just miss out the FX. And of course, no one at 21Shares or the authorized participants or any of that lot, no one's charging you the FX. There's no sort of slice there. You'll go in as efficiently as you can, and once you're inside, once you're in the city, FX spreads are virtually zero. It's only when you face the market where some of the platforms like to charge high commissions for that.
Thank you, Charlie. And maybe just a follow-up question. Why is the location of the London listing so significant? What are the limitations to investing in the overseas ones?
So this is a UK thing. If you're a German or Frenchman, no problem. You can buy the European ones. But UK investors have been banned by the FCA since October 2020 from investing in crypto exchange traded products. And that ban was basically enforced around Europe. So British citizens were not allowed to trade on the European platform. So they opened an account on a European platform. As soon as they found out they're British, they were not supposed to let them trade. So it was quite a ruthless thing. And so the only exception to that were if you're an elected professional, which basically it means you earn lots of money, you have lots of money, and you know lots about finance in a nutshell. And if you pass those tests, then you were able to go and deal basically the same tests as buying a hedge fund. If you could pass those tests, then you're allowed to buy a hedge fund. You're allowed to buy a crypto product in Europe. So that's basically, it was just a UK rule. And fortunately, they've eased those rules and they've now led us back onto the London Stock Exchange. And there's still a bit of a fight with platforms. I can see some platform questions there. But nevertheless, we break each door down one by one.
And I think it would also help if we collect those questions, because obviously it helps if the investors push themselves, but we also want to make sure we push from our side that it's available on all the different platforms, which it should.
Yeah, well, maybe just another word on that. Some people are, where can people buy this now that we know of in the UK, and what can be done to encourage others to list it?
Yeah, so I think that the retail access to Bitcoin ETPs was allowed in middle of October. 21Shares launched their products, as did others in Bitcoin and Ethereum. This is the first sort of product that's come along since that period in the UK. Now, many of the platforms have resisted. So Hargreaves Lansdown, AJ Bell, they've all held back on the ETPs, and I think they're all going to come around, but they're trying to figure out internally their process. And so it is being tricky for them, because there are lots and lots of rules that they still have to adhere to, suitability and that sort of thing for their clients. So I think they're all trying to figure it out, and I don't think it'll be too long before they all make announcements. Hargreaves has said they're going to make an announcement soon, so have AJ Bell. But the only platform, and this is day two for Bold, has been interactive brokers have come through. And we expect many more to come through, but it will take time. And the way to hurry them up is to write in. The more people that write in, the more quickly they will make a decision.
Indeed.
It's not something we can do. 21Shares has briefed all of these companies over the last few months. It's all happened in the background, but that doesn't get it on the platform. It takes client demand.
Indeed. Well, so to all the different people who sent in that genre of question, we've bundled it into that one. But a sort of semi follow-up to that would be just UK rules on inclusion in an ISA or a SIPP.
SIPP, yes, no problem there. ISA, no. HMRC have made a ruling that crypto ETPs will not be held in an ISA.
Do we expect any change on that in the future? Is there any possibility for engagement there? Or
I could call HMRC saying they're going to reduce my taxes. I doubt it.
Good answer.
But I suppose there is a sort of innovative ISA thing that they're talking about, which no one really understands. But I think that the cryptos will be allowed in that, but we're just not sure at the moment.
Okay, thank you. Next question is an interesting one. Is that in terms of AUM, do you think there's a number where size could be an issue? Obviously, would be a nice problem to have.
Yeah, AUM 40 million at the moment. It's really nothing. So, what markets are we facing, Adrian? Bitcoin and gold, 150 billion dollars a day of liquidity in gold, and $40 billion a day of Bitcoin. I think we could be in the hundreds of billions before we'd have a problem. Bitcoin's a 2 trillion asset, and gold's a 30 trillion asset.
30, 35 almost soon. Yeah. I mean, that's exactly the benefits of the primary market and its liquidity. So it got to be astronomically high that this becomes even a problem.
Can I also mention another thing there? We do our top secret investment strategy called buy low, sell high each month. and in that process, we're actually a stabilizer for the two markets, because we're taking money out of the hot one and putting it into the cold one every time. So if lots of people were rebalancing their portfolios, that's a volatility dampener for the assets. Yeah. Whereas if you were going the other way, you're chasing momentum, that would be adding to volatility. So I think the bold strategy is a force for good in both markets. And obviously, but if it was large, it would be great.
I also think if we assume the AUM of the product grows to $500 billion, which obviously we hope it will, that would imply that Bitcoin and gold have a much higher market cap at that point, and therefore even deeper liquidity, and therefore that shouldn't be a problem at all.
Yes, I look forward to that problem.
Yeah, likewise.
Indeed. That was a great response, but there's a good devil's advocate as well that I'm going to read out, which is that as sovereign wealth funds, governments and institutions buy Bitcoin and treasury company hold it as a reserve asset, maybe by the 2030s, with the structure of Bitcoin as well, you could see a much more limited supply as it becomes more of a sort of closely held reserve asset. Is there a possibility that if supply dwindles as these entities hold on to it, that liquidity could be reduced even if it were a larger market overall, and that the rebalancing thesis could be affected?
Adrian, do you want to have a go at that?
Yeah, absolutely. I mean, it's a very good question, but I think what's important to understand is that the bold strategy doesn't rely on the Bitcoin supply. It really relies on the observable price and the volatility. So obviously, if the scarcity makes Bitcoin more volatile, the bold strategy would automatically reduce the exposure and vice versa. Why am I saying that? And I think the question is alluding to the so-called supply shock when it comes to Bitcoin. And we get that question actually a lot also from traditional investors, which is, what happens if no one wants to sell anymore? What if all the Bitcoin are in someone's hands and they don't want to sell anymore? I would tell you there will always be a seller. The only thing that increases is the volatility, also the spreads. The price might go parabolic, but there will always be a seller at a specific or a certain price. And that's why I also don't see it as an issue. What do you think, Charlie?
Yeah, I totally agree with that. That's the whole point of capital markets. If you can't find a seller, then you put the price up until you do. You'll find your seller at some price or another. And I think more importantly, Bitcoin, it's not something you would hoard. It's something that's a network, and it's a widely distributed asset like gold. I mean, most people in the world own gold, through jewelry or whatever. So probably more people own gold than any other asset, I would think. And Bitcoin, the idea is that will be very widespread, and everyone has a little bit. So it's a deeply liquid market. You don't need new supply to main market liquidity. You could stop mining gold and it would still maintain its liquidity. Gold grows about 2% a year, the supply, and Bitcoin's currently 0.9, and obviously halving every 4 years. So the new supply of Bitcoin does grind to a halt. But that just really was all about giving the market confidence. I've always said, and I was saying this years ago when people were saying that low supply equals rising price. I said, no, it equals confidence. Because if you think what the opposite is, let's say you printed loads of Bitcoins every year, well, they would have no value. But a low supply doesn't increase value, it just prevents lack of value. It's the other things that make the value. And Bitcoin's valuable because it's widely held and it's liquid and it's neutral. And it's highly correlated with the internet, which is growing. So there's lots of reasons why that's valuable. And the liquidity, I don't think, will be impacted by whatever the future supply of Bitcoin is.
I love that, Charlie. I'm going to copy that, but because it's absolutely true. I mean, it's not Bitcoin's value that is increasing. The Bitcoin price actually reflects the decrease in value of fiat currencies, right? So it's actually the other way around.
Yeah, that chart behind you, I mean, that one on the screen right now, I mean, it's just a magical outcome. They print money, Bitcoin, gold go up.
Yeah, on that actually, someone has commented the money supply chart is very compelling to the performance of gold. But how would you see performance if, heaven forbid, any government or central bank decided to contract the money supply?
It would go down. Bitcoin and gold can go up and down. Bitcoin and gold do go up and down. They're currently going up, but they will at some point in the future go down. I don't think at any point has anyone suggested that gold just goes straight up. Bitcoin, the bull strategy outperforms the average of Bitcoin and gold. So let's say they're both down. Well, hopefully we'll outperform that. But Bitcoin and gold, why would they go down? They'd go down because the wars would stop, as John Reed was just telling us in the other video we've done for Bold Week, for the launch, celebrate the launch. Because the wars would stop, there'd be a peace dividend, Globalization will be increasing. Budgets will be balanced around the Western world. Debt to GDP would be falling, and those sorts of things. If we had all that, then no one would be buying Bitcoin and gold.
And yeah, here we are with all of those things very present in the world today. If they were both to go down together, someone asks, would you increase cash holdings in the ETP and to what percent?
Well, we can't, because there's an algorithm sitting in Kaiko, and it invests in Bitcoin and gold. That's it. But the client has the ability to make a decision. So if the client thinks Bitcoin and gold is going down, they can very easily and very cheaply and very efficiently sell their gold. They're not locked in, so if they don't like it, they can sell it. But, it's Bitcoin and gold only. There's no cash. And it's nothing to do with me. I invented it, but it's nothing to do with me, the amount of Bitcoin and gold in the portfolio. It's purely up to the recordings of volatility in the market.
Maybe I can sneak in a question because it might be interesting. Obviously, we always say the volatility of Bitcoin is coming down. Charlie, we launched that product in 2022, right? What was the initial weights of the two assets, and how are we looking right now?
Yeah, I'm pretty sure it's 18 and 82.
Yeah. I think if I remember correctly, that's about right. Why now we're at 60, 67 and 33 or something like that. So it kind of shows that the volatility of Bitcoin is compressing in the long run as well. Do you think we will see a 50-50 split anytime soon?
I think if we do, it's probably not because Bitcoin's volatility comes down to 19, 18. It's more likely it's because gold's volatility goes up. So I think they'll probably meet in the 20s. If that happened, it's because they meet in the 20s.
Interesting.
That's my view. I mean,
Could I just say we're going to have to wrap up in a few minutes, in not too long, but there are lots of questions coming in. So firstly, if we don't get to your question, we will write an answer and publish them all for everyone. So we are going to take note of the ones we don't get to. But the next one quickly, what are the management charges for Bold? How have they changed? Will they change?
Very, very easy. It was 1.5% for 2.5 years whilst the fund was tiny. And then as we crawled towards 10 million, a year and a half ago, they were cut to 0.65. So now it's pretty good value. I mean, it's quite a low price for the quality of the product, frankly.
Next question. Does JP Morgan store the gold in fully allocated custody so that they can't lend it out, or is it stored in unallocated custody?
Fully allocated. Fully allocated. Can't be lent, can't be swapped, that sort of thing.
Very important to mention that, indeed. There's a couple more. Where is the Bitcoin bought and sold? Is it on an exchange or over the counter with an institution?
Adrian?
It's but it can be both, but mainly OTC.
Thank you very much. There's a question around dividends. Would Bold ever pay a dividend?
If gold pays a dividend and Bitcoin pays a dividend, we'd gladly pay a dividend. I don't see how that would ever happen.
Perfect. And then one final question for me is just, could there ever be a divergence between the price of the underlying asset and the price of the index? And is there a possibility that arbitrage could occur in that situation?
Sorry, can you repeat the question? If there could be a divergence between the price of the product and the index?
Yeah, or of the underlying assets. Could there be a divergence between the two?
Will the ETF trade at NAV? Is that the question?
Yeah.
Yes.
And what happens in that situation?
An investment trust has a NAV, there's a share price, you buy and sell shares, they're too high, they're too low, they tend towards the NAV. In an ETP, there's an instant arbitrage. So if we went to a 2% discount, a clever dick will come along from a hedge fund and just snap it up and sell that Bitcoin and gold in the market in a second. ETFs don't do that, right? Some of the wacky ones, illiquid assets, occasionally do that. Some of the credit ones during 2008 did it. But these are two liquid assets. There's no reason for this to ever trade at a discount or a premium to NAV.
And I think once again, this is the beauty of the primary market and the IPs creating and redeeming new shares together with the arbitrage. That's what keeps it close to the NAV and why it tracks it closely.
Perfect. Thank you. Well, just a few things to say at the end then. Firstly, to those people who also sent in kind comments about the product and the concept, thank you very much. I hope everyone who's watched has really gotten a lot out of this chat with Adrian and Charlie. We really appreciate all the questions. There are a few that we didn't get to, and we will write those up for you after the session. But I think that's all from us today. So firstly, Adrian, thank you so much for joining us. It was a pleasure having you.
Thanks for having me. It was fun.
And Charlie, again, in a big week, taking the time to come and talk us through all of that was brilliant. So I hope everyone's appreciated it. And thanks for joining us.
Kit, you probably figured out that I can't stop talking about gold this week. I rather enjoy it. I'm really glad to have Adrian. I mean, there are lots of great people at 21Shares we could have had on for this, but he's the real star.
I appreciate the kind words,
Adrian,
Charlie.
tell me my favorite story, because I just love this story.
You're referring to why I'm still working and I'm not retired? No, Charlie loves that story because how I ended up in crypto, my first encounter with Bitcoin was actually around 2011, 2012. And I was in the States back then. So, and I found Bitcoin, I found it very interesting. I invested some money, but I didn't really held on to it because I wanted to go to a nightclub with my friends. And obviously I was a broke student. So I sold off quite a big chunk of Bitcoin just to get wasted with my friends. And yeah, I don't have any regrets. It was a good night, hopefully, but it sparked my interest for financial markets, for the crypto asset industry, and I'm still here. So, and I'm enjoying the ride, I have to say.
So, Adrian, you sold a few Bitcoin at what, sort of $10 each or $20 each or something?
That's about right. It was sub $10. Yeah.
There you go. There you go.
Good old time. And it was really hard. Actually, it was really hard to access Bitcoin. It was not that easy back in the days. I needed a friend who studied computer science to help me with it. While nowadays you can just buy an ETF or an ETP, an ETN. Of course, you can use other methods, but I can tell you back then the access even was a pain.
It's come a long way.
It's come a long way.
Thank you, Adrian.
Thank you, guys.
Well, just for me, I will say also, if you enjoyed this video, do go to our YouTube page. We've got two others that are going to be on there by the end of the week if they're not already, celebrating and marking this momentous week. So well done on the London Stock Exchange listing, you too. Thanks to everyone again, and we'll see you for the next webinar.